Fantastic. Thank you guys for joining us. I would like to start off with real quick intros, just 30 seconds or so, and jump right in from there.
Okay, I'll watch the timer. Hi, I'm Michael. I'm from Seed Plus. We're a seed stage VC firm here in Singapore. I think newly announced, but so there's no conflict of interest, investor in ZPX. And just excited to be here and going to be great to have this chat out in the open.
My name is Vishal. I'm a partner at 500 Startups. We are a global venture capital firm. We invest across multiple verticals. We've done about 2,300 investments in 70 countries. I run 500 across Southeast Asia. We have a whole bunch of companies, around over 200 over here in the region. We have invested pretty actively in blockchain companies. A number of our companies in Southeast Asia have done ICOs successfully as well. I should add that I am now actually out of a job because ICOs and, no one's taking venture capital money. So if anyone wants to hire me, I'm totally down for that. Yeah, it's just not a thing.
I'm Kenrick. I'm with Golden Gate Ventures. We're an early stage VC investing in Southeast Asia, about 40 investments. Our portfolio has also done a number of ICOs. It started like about a year ago with probably the most famous one that we had was Omise. They had a very successful ICO. Ever since, we've been looking into the blockchain kind of space, and that's why I'm kind of currently working on setting up a dedicated fund for that, in which we would invest into ICOs and token projects.
Hi, everyone. My name is Rex. I'm a vice chairman of Bansi, the oldest angel investment group in Southeast Asia. And I'm also the chair for the investment committee. We are running a seed angel fund as well. And I'm also part of Assess as part of the head of education. Then very quickly, my background is software engineering. So started coding since the late 80s using the DOS platform, computer games. And then in the 90s, did some work relating to cryptography. So created my own algorithms. Then moved into angel investment about 12 years ago.
Well, thank you for that. So VCs took a bit of a battering today from Tim Draper saying that their VCs are going to be obliterated, and Meltem infamously wearing her sweatshirt saying VC is dead. So we'd love to get your thought process of what you guys are thinking on the other side of the table.
I think we're all looking for work.
Yeah.
I don't know. I mean, it's interesting. Of course, every industry has to evolve. And I actually thought what I heard from Tim was VC needs to get better for what they do. And he was saying it's expensive money for low service. I think that there would probably be founders who agree with that context. Mm-hmm. So I think you have to not be that, right? Be of value and make a difference. But I still feel like if you look at some of the more successful blockchain / even things that are tokens, there's usually VCs in the mix as well as even a token, right? So it doesn't seem to me that it means we disappear, but I think every major change in the world creates some effect on an industry. So for sure, this is going to affect the industry.
Absolutely.
I don't think we're disappearing.
Yeah.
We'll see.
What are your thoughts on that? Vishal, Kenrick?
I think, the last time I checked, the job of a VC was to find and assess kind of early stage companies or projects. And I think with ICOs, there will be plenty more early stage projects and teams to assess. So I think it's actually a boon for our industry as long as we remain fluid in like the way that we can invest, whether that's in tokens or in equity or a combination of the two. I think it's actually great for us, like more startup companies.
Charles, would you like to add? Dr. X?
Yeah, as the saying goes, a picture speaks 1,000 words. So I need to refer to my slides. Can I have the next slide? Number 1, funding, VCs, hybrid, and ICOs. So this particular slide is from a PwC report a few months ago. And they talk about the traditional VC funding, including business angels. And then after that, on the right side, we have the pure ICO funding. And increasingly, I think there is a feasibility of hybrid funding. And that is currently the case happening within the business angel network as well. Yep.
I appreciate the slide. Thanks for that.
That was like epic. Like I love it when people do that on panels and you're like, whoa, rabbit out of the hat. I don't have anything going for any of this. I think this is the question du jour for any conference and panel that I've been on. So when you told me earlier that I'm going to spice things up and ask how VCs being devastated by ICOs, I was like, oh God, this has been happening for 2 years now. I think that raising money through ICOs or whatever it is people are doing with blockchain is just going to augment money that's coming from venture capital as well. I don't think anyone in the industry is going to die anytime soon. It may make it more competitive because there is more money that is coming into the industry through a different source. The question is, who adds value, right? And where are the most competitive deals and the best founders going to raise their money from? If you know exactly what you need to do, you don't need any expertise or help, and believe that you can do it through an ICO directly on a white paper without anything developed yet, you should go and do that. Go ahead and do it. But not all companies share that same makeup. And so we see it as well, like when we speak with companies in the early stage, a number of our companies, knowing full well that they will raise an ICO down the road, still go first and raise venture capital. So they have some credibility or backing when they go out and raise through another source of capital. I mean, that's the way that I think about it.
Oh, thanks. So from a VC perspective, how do you explain that to your LPs? Because the LPs traditionally were told that it's early stage or growth stage or late stage. So what does that process look like?
I think, generally, because I've had people ask me, like, if you look at a fund, and maybe I know everybody has their own fund strategies and thesis, but generally someone doesn't go in all one thing anyway. So it'd be even in your own personal investments. You might say, I have some in cash, I have some in stocks, and now I guess people are saying I have some in crypto. I think a fund's largely the same thing, right? So generally LPs know that this is an asset class of sorts, both from a technology disruption perspective and the fact that crypto is in it. So I think most understand that as a fund, you're going to be looking at these things, and to be completely sitting out of them is probably worse than doing something in it, right? So I think most understand it, and enough of the big VCs that kind of set the tone for some of this around the globe are already doing this, and then, of course, the LPs around the world are largely the same, right? So I think they know this is something that's going to happen. Now, whether or not they suddenly expect that every single deal that comes through is an ICO or a token, I'm sure they'd be shocked by that. But to understand that you'd be investing in something in the space, I don't think most LPs would have a major shock to it.
How many people in the audience are familiar with what an LP is? Okay, so LPs are investors in venture capital funds. Just like founders go out to raise capital, VCs need to go out and raise capital from LPs as well. They're larger pools of capital, so imagine there's always a bigger fish in the ecosystem with more money who's giving it to someone. That's what an LP is. When we have conversations with our LPs, they usually revolve around a few topics. First is, oh my God, my friend is investing in this crypto thing. Are you guys in it because it sounds like it's awesome? And so then you've got to explain, no, we are not a cryptocurrency investor. We don't do it. And you have a conversation around that line. The second type of conversation revolves around whether we are allowed to invest as a fund into crypto assets. And that's an interesting conversation because most funds are not allowed to invest in those assets to even begin with. So I think that one of the larger shifts that you're seeing in venture capital is funds amending their what we call LPAs, which are the agreements between us as a firm and the people who invest money in us to allow us to invest and hold those assets. So I think firms and funds that are able to move faster along with these trends will do much better for themselves because they are adapting the way they do business now. A lot of our conversations have revolved around this part of it. What's interesting about 500 in particular is that we've been investing in this technology since the firm started in 2010. Our first crypto batch was in 2012. One of the companies was actually from Southeast Asia that was in the Valley, CoinPip. They're still around. Anson and Alexander, who run that company, are still around over here. I think the rest of the companies might not be. But that's kind of the way that the conversations with our LPs have been going so far, which is, can we hold the asset? How are we thinking about investing in the space? And how do you give LPs exposure to this asset because they're very interested in having some exposure to it through venture?
Yeah, if I can add to that, so that's some of the things that we are going through now. Like even if you get agreement from your LPs to be able to invest in this asset class, you run into a multitude of other things, right? So first of all, once you start investing in crypto, you're creating a fund structure that's kind of a hybrid between a VC firm, which is a long, normally a 10-year closed-end fund, and a hedge fund, because hedge fund is like a liquid kind of vehicle in which you can subscribe and take money out. So what is an ICO fund or a token fund? Is this a long-end closed, but we have liquidity, or is it more like a shorter open-ended fund? And then you start talking to lawyers, and they don't know, and then you start talking to other lawyers, and they don't know that these are new structures they haven't seen yet, which is a reason why a lot of institutional capital is not entering this space. And once you figure that out, then you go to you come to the fact that you will not be able to get a bank account in Singapore for a fund like this. This is something that we went through. So that's obviously an obstacle for more kind of larger pools to enter the space. And then you come to the biggest question of all, I think, which was touched upon by a number of speakers, which is just the whole security and custodianship of these things, right? Like, I'm not going to store a Trezor with a few $1 million in my office, right? Like, I need some kind of other solution with multi-sig wallets, with cold storage, with like multiple parties who sign the transactions. Oh, okay, all right.
I'll keep it for you.
Yeah.
No worries.
Yeah, so for Bunsey, when we have our angel fund, we do not have the constraint of the VCs. So in the first several companies that we have invested, mostly are all equity. And then we were blessed with one of the recent company that came and pitched. They are in the midst of launching their ICO, and we also make an investment in them, so in the form of equity. And moving forward, now that our first fund is almost used up, we are actually planning to get started with the second fund. And the second angel fund, will be a lot more interesting than the first, because we will be seeking mandate from our angel investors to invest both in the equity mode as well as tokens modes. Yep.
So that's interesting. So would love for each one of you to probably run through a use case. I know GGV has Omisego, 500 has a couple of investments as well. We'd just like you to run through a use case of how you viewed a deal and what were the constraints that were different from a traditional tech deal that you may have seen before an ICO.
In terms of investing in ICOs?
Yeah, in terms of investing in anything blockchain or crypto related as part of your fund, what were the mechanisms that you use that were slightly different from what you would traditionally use in a food startup, for example?
Yeah, this is the $1 million question. Like, so to be clear, we did not participate in the token sale because that's again in the LPA, that's not allowed in our current fund. But there are lots of questions around this, and there's no easy answer at the moment of like how these token sales actually influence the underlying equity of the company, right? So some spin it out as a separate entity, and then it's 100% owned by the parent company. But then basically, if you issue a token, that's kind of like taking value out of the company and distributing it around. So, like, what is the term sheet in the future going to look like? That's going to be probably some kind of clause in it that says like, okay, you get seed funding from us, but then if you do a future token sale, we're going to get a part of that token sale. Like that. To be honest, nobody has really figured it out, I think.
Right.
At least not, I think, on our side.
I feel Michael has, though. You had told me just before.
I mean, I think
there,
there's a couple, I don't know. Again, I think the problem with this as a VC, and I think, is until you've kind of done some stuff, you basically haven't done it, right? So I think, every company look at different. So I think there's a couple things. One is looking at just how to value a company, how to deal with it. And I think normally when you're talking to these companies, at least you can have an open discussion about it. They're like, what is the plan here? Do you plan on doing token? Do you plan on having another equity round? And then figure out from them where you sit in it. And I think we've looked at a bunch of things that we've said no to because people can't give us good answers for this. They say they don't know, or they're not sure what the plan is, or if they do this thing, they don't know if the VC should get some of it. And then there's the idea that might grow, but the equity in the company value doesn't, like they don't, the winds aren't all aligned here, right? And we've seen a lot of things where essentially the people in the company are making more money than the investors because they're going to get tokens. And so these things are quite complicated. I agree. I don't think there's a playbook of sorts, but there are some common instruments. I think SAFE is the one that people are using, or the SAFE Ts, right? But one of the things that we came up against was they're kind of a one path. You convert to token or you convert to equity. Well, what if you want to do both? Or what if you need to manage both simultaneously? So we worked on something in-house to deal with that, still using kind of a note construct. But I think going forward, this is going to get complicated because, again, how do you deal with valuation? How do you do your mark-to-mark on your fund? Like these, but at the same time, these are okay problems to kind of go through. But I think one of the things that I've noticed is there isn't a lot of sharing in the community about this stuff, right? Because generally people don't talk about deals, they don't talk about paperwork, they don't, so the funny thing is when I was trying to work on these and I'd ask them questions, they were like, I don't know. And whether someone knows and they don't want to share or whether they actually don't know could be the same thing. But I think as a community, especially in the Singapore ecosystem, there isn't a lot of, how many VCs have done this? How many, large deals have been said? So I think hopefully with more conferences like this and people opening up to that this is a real thing, right? This isn't going away, that we'll get better at the paperwork and get better at the finances and the custodial things and how to manage it. But these are all opportunities, right? In fact, I think there will be startups to get into these problems and try to sort them out, right?
Yeah, if I may contribute. So another rabbit out of the hat, maybe previous slide. Previous slide, please. And then if you can click on SCM. So about assurance for crypto investor.
Great.
Anybody knows what's the similarity among these 4 ICOs?
BitConnect.
Yes. So if you can click.
What's up?
Next. So essentially there are various statistics that talks about the percentage of scams amongst the ICO, and it range between 5% all the way to 81%, so which is pretty scary. Next. So these are from various sources. Next. So traditionally in the Bansi, we actually organize pitching session for startups to come and present their pitch to us. And it gives us a lot of confidence because we have a chance to ask various questions, including very uncomfortable questions. And then we get to see how they respond, so the body language. And thereafter, for selected companies, we would actually continue with a more in-depth due diligence to the extent of asking them to open up their bank statements, among others. Next. Whereas for ICOs, most of these projects are online and all over the world. As such, what we have at most for a start is the white paper. And I've been spending tons of my time reviewing quite a lot of ICO in this particular website called ICO Bench. I wonder how many of us knows of this website? So it's a very well organized website, and you have all the material. And my due diligence in this ICO company can go pretty deep and pretty uncomfortable to some of the team members as well. So I will typically look at the white paper, thereafter visit their Telegram, and then go through various standard questions like where are they based, what's their vested period for the tokens, whether they have a GitHub repo, among others. And then at times when I feel that a particular founder may be fake, whereby they just pull someone out of the air, I will actually request that I want to talk to that person. And there are certain companies that actually get uncomfortable with that, and to me that is red flag. So very much as an investor, whether are we investing equity or are we going to invest in an ICO, many a times it's about identifying how many red flags are there. And then through various due diligence, as much as possible to clear the red flags to green flag, if not, at least the gray flags. Yep.
Wow, I think after this, Dr. Rex is going to give a talk on how to turn a panel into a keynote. Like, this is amazing. So this is like remarkable. I think the way I see it is 2 separate things, right? The first is that making investment decisions, just like Michael, we don't invest in tokens, like as a fund yet. What we invest in is equity in companies that are developing blockchain technology, like or use cases for blockchain, right? And so when we assess deals like that, we look at it just like we assess any other deal. There's no remarkable difference between it when you're investing in equity in the company. The second part of it is actually execution, knowing that a company may have an ICO in the future. And the question is then, how do you structure the deal? What are the terms of those deals? How do you benefit from the token sale? How do you get that liquidity? How do you hold those tokens? All of those things, right? Which are the things that Michael talked about. And all of those go into the deal dynamics, execution, terms, all of that jazz. So that's a separate question altogether. But when you're investing in these deals, like when we're investing in equity, I don't think it differs very significantly or fundamentally from when we are assessing or doing diligence on deals that are not in the space.
So more specifically on that, how do you assess the regulatory risk that comes along with these projects? Because, I mean, that's a huge issue across the board at the moment.
So it would be the same. Oh, that's a great question. And I think it would be the same. We were early investors in Grab as well. And at that time, ride sharing also had its own share of regulatory issues. So do companies like Airbnb and companies like that, right? Like there's so many spaces in which regulation is unclear or gray. And I think to a certain degree that you have to take some risks, especially when you're doing early stage investing in a new area. And you are throwing the dice to a certain degree to figure out where things are going to land, right? You don't know for sure. It's kind of like Schrodinger's cat. Like right now, you have no idea where it's going to land. For some types of products, I think that you have a larger degree of certainty when you know regulation is impending or coming. You can take, for example, cues from other jurisdictions that may have issued regulation and then see whether those are likely to be applied where you are. But it's anyone's game, and I think anyone who tells you with certainty that we are able to predict and tell you what's going to be regulated and what's not and how, and our investment decisions are sort of like attenuated to that, I don't know.
But yeah, so one of the things that's kind of crazy about the whole sector, right, is like, if I think I'm old, so I'll go back to when I did one of my first startups. It was rack up Solaris servers, put the OS on it. In fact, we had Netscape Enterprise Server, which came on a CD, so we put it in the Solaris box and load. Like, now you would never do this today, right? But yet I know there's companies out here who, a regular company that has nothing to do with blockchain is gonna do an ICO, and they have like 2 smart contract engineers, and they're working on creating a token, and I'm like, crazy, really, right? Because you go to Amazon for a web service, my view is you're going to go to some company for a token, just like you go to your JP Morgan to do an IPO. You have people basically who've never done any financial instruments in their life, basically writing a white paper, which is then turned into an ICO, and these people have never worked at a bank. They're not even good writers, but yet if they can hire somebody to do it and they can jazz it up and they ship this thing, it's a token. No wonder why there's so many scams, right? Like the whole notion of diligence. So, you know, that has to change, right? And you know, and I guess if people want to keep stupidly giving their money to these things and keep losing it, that's between you and your money. But the world isn't going to function this way. And I don't think that changes the benefits of crypto or the benefits of decentralization or privacy. But you would want to work within the utility and the systems that are designed to help you do these things. Because there's just no way every company's going to have 2 blockchain engineers and 2 smart contract engineers and somebody to write a white paper. You know, it doesn't make sense to me. And that's the part that I've never really been able to wrap my head around. And this is, I think, the Wild West notion of where we're at today. And I think that has to come to an end, right? Because there's just no governance there. There's no ability to check liability. You know, and you hear, you know, the tokens go to people's personal Coinbase's accounts, but they're actually money for the company. And you're like, wait a sec, if I was a VC and I was getting your funding round done, and you say, "Oh, here's my bank account." Well, this is the CEO's bank account. Oh yeah, that's okay. I'm taking care of the company. But yet in crypto, this is happening all the time, right? You're giving the guy goes, "Well, where do you need your 2 million of Ether?" Well, here's my personal Coinbase account. Wait a sec, like in the real world, this wouldn't happen, but yet it's happening all the time. So I think this whole infrastructure foundational layer is so early that basically crooked things are being done because there's not enough tools in governance. So I, for one, am happy that there's going to be governance and some level of central bank oversight to this stuff, because that's just how the world works. And the idea that this could all be, you know, under the table doesn't make sense to me.
Yeah, if I may add, this material I did not prepare, so it's in my laptop. So there's this particular framework called token classification framework. You can Google search for that, token classification framework. And there are 5 parameters within. So it covers what is the type of token, what is the purpose, what's the underlying value, what's the utility and legal status. And then, for example, giving let's say for Steam. Steam itself is the blockchain native token, and then it's a network token, as opposed to investment token, which is an increased risk. Underlying value is a network value token, and it's a usage token, and the legal status is a utility. So I think as far as the risk that is concerned, depends on whether are we investing from the fund level or individual level. So naturally, at the individual level, we may be able to afford the higher risk.
So Kendrick, a more specific question for you, since you guys are looking at doing a carve-out as a blockchain fund. How do you go about thinking of charging carry, for example? What sort of liquidity timeframes do you look at? What is the thought process behind it?
Do tell.
Yeah. Let's say we keep it to industry standards.
Industry is okay.
These are very good questions, and these are very hard questions that are not easy to answer. Yeah, we will go with industry kind of standards without
Brilliant answer.
Yeah, without saying too much. The more interesting thing, I think, from the previous kind of point on the regulatory side, I think kind of the champagne party of like the utility token is coming a little bit to an end, right? Like, why would people buy a utility token? This was kind of a stack thing, you invest and you exit and you invest, and like that, like it's a glorified kind of Kickstarter thing. Like, as an investor, you invest with the expectation of a return, and an expectation of a return only comes if you have some kind of right to the underlying, either the asset or like the future cash flows or whatever it is, right? And a utility token just simply does not do that. So I think you already start to see that all these deals are starting to move private. That makes it easier on the company, so they get less in trouble with the regulators on the KYC side. And the AML side. So already the utility tokens are moving private, and I don't know, nobody knows the future, but I would expect that more and more of these tokens are going to be securities once there's proper regulation in place. And unfortunately, I don't like to agree with the SEC very much, but in this case, yeah, almost all the tokens issued are securities. Because people have the expectation of future profits, not just access to a platform, right? Like, if I wanted to get a new pair of shoes, I can go on Kickstarter and
right.
pay $100 for that.
Yeah, if I may interrupt, so there's an interesting question from Pigeonhole. So we invest in coins versus project. So for projects, we have an exchange platform and protocol. Which do you prefer?
Actually, I would like to tie that back up again to the liquidity question.
Okay.
Right? So, I mean, I've done early stage investing, I've done late stage investing, and I've done crypto investing as well. And the liquidity premium, and from a risk reward perspective, early stage and crypto seem to be the same to me personally. I don't know how you guys are thinking about that.
Same to you, what, in its liquidity capabilities?
In risk reward perspective. Yeah. So, I mean, early stage, 7, 8 out of 10 companies will probably fail. Same in cryptos, you can take a basket of 10 and probably 7, 8 are going to go to zero. But at least you're liquid from day one when you participate. So what's the thought process around that?
Well, I do think it's interesting if you're in something that converts to a token or parts of it. I do think what actually is interesting in VCs is some level of possible early liquidity, right? Which for seed investors, we're looking at 3, 4, 5, 6-year time horizons unless there's an acquisition or a secondary sale or something. So generally, yeah, the window's much longer. So I think what's interesting about the hybrid approach, which I think you'll see more and more, is there's opportunities to sit some with the company and opportunities to take some out as a token. And I think you'll come up with some ratios that make sense for the kind of fund you're running. But I actually think that's what's interesting, right? Is that you have possibilities of early liquidity in such a way that you're not damaging the company, right? Because if you're talking to founders all the time, they know early liquidity for us means something forceful to them, like, oh, are you selling me, or someone, and we all know we don't do anything. The founders do what they want, right? But of course, if I were to pressure for liquidity, that forces them to do something, sell some secondary, or early exit your company if it was that simple to do, right? But if we're all on the same side of the table of a token, well, I'm benefiting them by basically there's no pressure there for me to actually get some liquidity if they're in a market that has it, right? There's other problems with tokens where maybe there isn't liquidity. So I actually can have some liquidity and I still have some equity, and everybody's probably okay, right? I still think there's a model to be sorted out, but I think it's not forcing their hand to get liquidity because they've given us access to the token. That's the design, right?
I have not a different view from what Michael said. I agree with everything he said. But my perspective is this. I think that you can't compare investing in crypto to early stage venture at all, actually, in the way that it's done right now. And I'll tell you why. Like, the risk profile and the way the businesses work are very different. The first is that you categorize venture as being early stage because of, for example, the amount of capital being raised and where the company is at. And usually that capital falls into a certain range to hit a certain milestone. You're raising anywhere from, like $500,000 to $2 million. And what you want to do with that money is you want to hit a certain milestone. You want to, like, for example, get product market fit, or you want to hire out a team. You want to do something like that. And you understand based on precedent, because everything has been done before, how much the company needs to get there. You can model it, you can understand it, and okay, you know that they're going to hit a certain stage, and here's where you're investing, and this is kind of the risk profile for companies at that stage. In crypto, no one's raising $500,000 on coins, right? In early stage investing, the founder is on a fairly tight leash, right? You only have a limited amount of runway. That runway is usually going to be 12 to 18 months until you get to your next round. Incentives are aligned because the investors in your company, especially when you're looking at beyond angel and you have your first rounds of institutional capital, they're patient capital. These are funds that have 10-year cycles and are operating on that mandate. In crypto, it's completely different when you're investing in coins. The first is you raise a ton of capital. You don't have that tight leash, and you can afford to stay out of fundraising for a very long time if you really want to. What are you going to do with $20 or $30 million in your bank, right? The incentives are misaligned for a few reasons. The first is your investors can leave whenever they want to, right? And the second is there's no incentive for you to run the company in a financially or fiscally responsible fashion because there's so much to go around. This is how much companies usually raise on average in the lifespan of their fundraising, right? So I think it's very different. I'm not necessarily sure you can compare it both on a risk basis or in any other way say that it is analogous to early stage investing. But that's my view, and I might be wrong.
Yeah, just one point to add. Also, the token just makes transfer of value easier. It's just transferability. It doesn't mean liquidity, right? So the more and more projects that come out, like, you don't get listed on the big exchanges anymore. So if you do a new project now, I mean, good luck finding your liquidity on Ether Delta, right? Like, go and exchange and sell a few $100,000 of tokens there. It doesn't exist. It just makes it easier to transfer, sure, but doesn't mean there's liquidity. It's, yeah, same thing.
Great points. Would you like to add something? I think we'll take another question. I think we covered this. Do you guys want to have any more points on that? How do you value projects that intend to do an ICO? Any other points? No?
Is this like giant red sign?
I think we're...
I can try to respond to the valuation of ICO companies. So essentially in Bansi, one of the way we prefer to value an equity company is based on the previous round of investment. And then from there, we give a premium accordingly. And then the case study that we have is we have one company that came to pitch, and that was before the ICO. So we determined that the valuation was a particular figure. And then thereafter, when they managed to, I've actually responded this point in the pigeonhole as well. So when they managed to raise a lot of millions of dollars, so naturally when we go back and say, yes, we will invest in your company, then their response is, No, not at that valuation. So naturally, from the investee side, they ask for this, and then what we want is this, and then in the real world, it involves negotiation, and then we end up meeting in the middle. So that's the reality.
Well, thank you guys so much, and thanks for joining us.
Yeah, thank
today.
you.
Thanks for having us.